Hi, I'm Taylor. Let's talk about how to use a standard financial model to model a marketplace business. Now, the standard model is built to be an accessible model to model any type of business. And it's easily flexible to use the core pre-built revenue model to model a marketplace business and then add on any additional revenue streams associated with it. So, let's talk about how to do that. The core part of it is that the core assumptions are on the get started sheet and the revenue calculations are on the revenue sheet. All the revenue calculations then flow into the forecast sheet, which then flows through all the financial statements and everything else. The forecast sheet is the key place to add in anything else you may want to add. If there's any revenue stream we don't cover that's not pre-built, it's very easy to add it and link it in here. But let's start and go through how to use the core setup to do a marketplace business. Now, the first part starts with the operational setup. So there's two terms here, and they're meant to provide some clarity for you to model out how you want to label things. So there's the aspect of we're having something that's growing, that's converting to something that generates revenue. So it would be common in a lot of marketplace business to have some idea of like traffic or leads or something driving to some central engine like a website, and then a certain percentage was converting to become customers or orders. And so I'm going to use this first step to be sessions, and then I say the revenue metric to be customers, for example. Now, I'm going to then select the marketplace option from here. What that does is it changes the setup in some of the calculations to reflect the marketplace business. So this first section here is around growth. So growth, conversion, retention, and then revenues. So the first section here, the acquisition side or growth, I can define the number of sessions in the first month, when that is, and then how fast the sessions grow. Now I can say, my basic setup is usually that it's going to grow at some rate, and then the rate of growth is going to decline over time. So growing but declining over time from a growth perspective. So that's why I have a 15 and -5. But you could also just say, hey, it's just going to grow 5% a month from there. And I'll show you how to adjust it more on the actual revenue sheet. It's also a seasonality assumption. A seasonality assumption shows up for both the acquisitions, conversions, and average revenues. The way that works is on the bottom of the sheet we have a seasonality section here. We can assume different rates where we expect higher conversion rates or higher growth or higher revenues, average revenues. And so usually what we do is we set up some percentages are positive and some are negatives. And what happens is that gets applied as an extra adjustment factor in the relevant lines on the revenue sheet to adjust the metrics accordingly. So we're going to leave this as it is right there. The next assumptions here are around CPA. This is basically going to say, hey, how much am I paying for traffic or sessions or leads, whatever that growth metric is. And then of the total kind of growth of the sessions, what percentage can come from paid? And the assumption is then therefore the rest are from organic. So that allows me to use an assumption around CPA, forecast out growth, which will then forecast the total acquisition expenses or marketing expenses spent on growth. There's other ways to do this. You can also model out the spend and assume a CAC, which drives the growth forecast. The core thing, either way works, but the core thing is that I want to make sure we're adequately capturing the costs of growth and not underaccounting for it. The next section is on conversion rate. So I'm assuming there's like 10,000 sessions that are happening, and I'm going to have 3% conversion rate. And I can assume whether there's a lag effect or not. So maybe it's someone I see a session or a lead, and then they may convert 2 months later, 3 months later, whatever. If I assume 0, it just means they convert during the same period. I can also choose to use the seasonality adjustment as well. And there's an idea of like a churn and a repeat. Now, if this was something I'm trying to model out, like I assume the customer is going to come back every month, for example. I can say this was one to define every month, and then define like a churn rate for it. If I think it's more like they're going to come back and repeat every month, then I can adjust the retention curve for that, and I'll show you how on the revenue sheet. So there's also the same assumption for cost per retention. So if there's any additional costs you want to factor into the acquisition costs or to the overall marketing costs associated with this, you want to factor some retention costs associated with it as well, just to make sure we're capturing if there's any spend necessary to continue driving people back, to make repeat orders. This flow is basically saying I'm acquiring customers, and the customers are repeating, right? To me, repeat orders. I could also just assume this is just orders, and then not use a repeat, right? Not worry about forecasting repeat business from that. So it's kind of up to you in terms of which way it makes more sense to the mechanics of your marketplace. So now the assumptions here is this is average transaction value per customer. And you can change the way the label is, but basically I'm trying to say what's when someone makes a customer makes an order, or when you have a subscriber on the marketplace, what is the total transaction value they make? Let's just assume they have an average transaction value of $100. And now what I can do here is I have the same. Reflects the billings. I'm going to leave that as 1. This just seasonality is also using the same seasonality impacts. And then what I have here, the most important one here for marketplaces, is these 2 assumptions. And what this basically says, okay, what percentage of the average transaction value am I going to keep as revenue? So maybe you have a 15% take rate, for example. And then $1 per customer's revenue. So maybe you earn $1 per transaction, or $10 per transaction, whatever it is, plus 15% of the transaction value. So what the model will do is the model will use the growth, conversion, retention to forecast out total transaction value, and it'll also forecast out the revenues from that transaction value. And that's different for marketplaces versus the other settings, which is not going to do the gross transaction value calculations. So let's see how this all works on the revenue sheet. So on the revenue sheet, we're going to start with the forecast of growth. Now the way this works is a lot of these metrics have a number of different lines that sums to a total. And usually it has this like general growth rate. The general growth that's forecasted from the assumption gets started. This is the actual kind of growth rate that's calculated from the assumptions. The seasonality impact, if you're using it, will be a plus or minus effect on the overall growth. And they also have a manual impact line. Now you'll notice that these are calculated numbers, but they're also labeled as inputs. And they're done that because you can overwrite the numbers if you want to. Like if you want to, instead of using the pre-built forecast to do that, I can turn them off and just directly enter in my forecasted growth directly in the manual input line. I could use the manual growth input line to put in spikes associated with like partner deals or conferences or whatever is driving some out of ordinary spike in activity in a month. Because the model handles them separately, that's going to be a spike in that month, but it's not going to just impact core growth rates from there. But I can overwrite the percentage growth if I want to reflect that. So it's a lot of flexibility to use either the pre-built methodology or build your own. So this is going to calculate out the total sessions that come from it plus the acquisition costs associated with them. Then I have the same flow for conversion rate, which is going to forecast the number of new customers per period. Now, when the new customers flow in, I have this a cohort-based structure for forecasting out how many customers we maintain over time. What that means is I have new customers flowing every time, and then here I continue to see for each new set of new customers their continued usage or their continued billing or their repeat transactions, for example. And so the model therefore does all the repeats, or the sum of the total the sum of the total customers or orders in that period is how many do you have plus the sum of all of the cohorts on their own retention path. So the retention rate itself is right here. So I mentioned before you can modify the retention curve. If if the assumptions I get started kind of work, right? These 2 assumptions are powerful enough to set your retention curve, then that's great. But you can also modify it directly on here. So you can overwrite the numbers I calculated from here with your own retention curve you want to use, and that'll get applied on a per cohort basis across all the new cohorts. The next set of assumptions here reflect like overall metrics around churn, net repeat, and then it does calculate the amount of renewed or repeat customers and retention costs associated with that. But the most important part are when it comes down to the revenue side. So the key here, what you'll see is you'll see the revenue model that's used, the revenue model used for transactions, the average transaction value. Now, by default, the model just assumes that it's that same 100 from get started. But you can modify that. Like because the average transaction value is still set on a per cohort basis, You could modify this average transaction value kind of to create a growth rate or have it increase after a year or whatever, and that'll get applied on a per cohort basis as a lag of when each cohort starts, basically. And so you have a lot of flexibility in being able to set the average transaction value, have it change over time if you have a strategy that's built upon that idea. And then these are assumptions for the average transaction value in terms of the average revenue or take rate per transaction value, and then the dollar per customer or dollar per order. And so from that, the model's going to calculate gross transaction value as well as revenues and billings. Now, how this shows up is it shows up directly in the forecast sheets. These automatically get pulled from the calculations revenue sheet. So let's talk about ways to modify this. Any other additional revenue streams you may have, right, are easy to add in. Maybe you have an additional business line, or you have a subscription component and a transaction component. Very easy to create a separate revenue model for that, using either duplicating the core revenue model here, creating two versions of the revenue sheet, and then linking them into here the same way the other one is. Like all these links just link, these actually just link directly from there. So it's easy, or you could use any of the other forecasting tools or your own model or your own calculations you built together. You can also use these lines here directly and use the forecasting drivers to layer in any revenue streams. The details of that, how to use the drivers, is covered by other videos I have around drivers. It's also easy to add any costs. So if you do have any costs of sold as part of the actual marketplace, you can add them in directly here. And I'm going to allocate it to a cost, product materials, or if it's hosting, I could do a cost of sales category or whatever I want to. And there's like a few different ways that I can do this. I could set up as maybe my cost of sales is $2 per customer per order. So this is total customers during the period right here, and I could say, well, starts in month 1, repeats every month, and it is number per customers. And so what this will do is it'll automatically take the forecast of customers and equate the cost as $2 per customer over time. I could also set this as a percentage of revenue, for example. So I'm going to assume 10%, percentage of, and of revenues. So this will automatically calculate out the cost of sales as a percentage of revenues. I could add on shipping costs, shipping revenues, other costs of sales. It's easy to add in other components directly in there, utilizing the pre-built drivers, especially because it can base it off of whatever's forecasted from revenue on the customer base. If you have any questions about how to model marketplaces, happy to help anytime.